So you look at Acme United, right? Ticker ACU. And you see those Westcott scissors that you probably used back in elementary school?
Oh yeah, the ones with the little green handles. Everyone knows those.
Right. And your immediate instinct as an investor is just to categorize them as this boring legacy office supply company.
Which is a neat little mental shortcut, but it is just entirely wrong.
It really is. Because when you actually crack open their Q2 2026 earnings call, which, by the way, just wrapped up a few days ago on July 23rd, that whole legacy label just completely falls apart.
Yeah, it becomes totally obsolete.
We are looking at a corporate identity that is undergoing a massive, highly calculated metamorphosis. I mean, they're quietly shedding that old school image and executing this full-blown pivot into a high-margin healthcare and safety powerhouse.
And they were doing it right under the nose of the broader market, honestly.
Exactly. So today, our mission on this Talk Tickers deep dive is to cut straight through the corporate jargon of this specific earnings call, pull out the hard data, and give you, the retail investor, a crystal clear, actionable signal on where this valuation is heading.
And we usually try to hit the most important takeaways in under 5 minutes, but there's just so much under the hood this quarter. We really need to unpack this.
We do. Because looking past the surface level has honestly never been more important than with this specific quarter for ACU.
No, absolutely. If you rely solely on like the algorithmic scrapes of their headline numbers on Yahoo Finance or whatever, the narrative looks super confusing.
Right, because the numbers kind of contradict each other at first glance.
They do. You have revenue shooting up, but then earnings per share is just sort of lagging behind.
Which usually freaks people out.
Totally. So to actually understand the long-term health of this business, we have to connect these quarterly data points, you know, the revenue, the gross margins, the operating expenses, to the broader macroeconomic picture.
Because they aren't operating in a vacuum.
Exactly. Acme is currently navigating this incredibly complex web of global shipping logistics, foreign exchange rate volatility, residual tariff impacts.
Oh man, the tariffs. We have to talk about the tariffs later.
We will. And on top of all that, they have a major strategic shift in how they acquire customers.
So let's just tackle those headline numbers first. Because the initial data drop is a masterclass in why you cannot just read a press release and make a trade.
Right. You have to dig deeper.
So for Q2 2026, Acme United reported net sales of $62.7 million.
Which is a solid number.
It is. That's a 16% year-over-year increase compared to the $54 million they printed in Q2 of last year.
And I mean, a 16% top-line jump in a consumer goods environment that has been pretty sluggish across the board, that is striking.
It really is. But then you look further down the income statement, net income came in at $5.1 million, which is only up 6% from the prior year.
Right. The gap starts to show there.
Yeah. And diluted earnings per share, you know, the actual profit attributed to each share of stock, accounting for any convertible bonds or whatever that hit $1.22.
Which is only up 5% from the $1.16 last year.
Exactly. So I am looking at a 16% revenue jump that only translated to a 5% EPS bump.
Yeah, that mess doesn't feel right at first.
On paper, that suggests they're spending a massive fortune just to generate those new sales, which, let's be honest, is usually a massive red flag.
It looks like a huge red flag, but only until you isolate the gross margin metric.
Okay, walk me through the margins.
So gross margin for this quarter actually expanded to 42.6%. That's up from 41.0% last year.
Oh, wow. So that's a 160 basis point improvement.
Exactly. In plain language, for every single dollar of revenue they bring in, they are keeping an extra 1.6 cents as pure profit before they even begin to pay for overhead, marketing, salaries, debt interest, any of that.
Which is huge when you scale it.
Right. When a company expands its gross margin in an inflationary environment, it fundamentally alters the underlying unit economics of the business.
Because they aren't just selling more stuff, they're making more money on the stuff they sell.
Yes. It means they either engineered a way to manufacture their goods cheaper, or they established enough pricing power to force the consumer to pay more, or, and this is key, they intentionally rotated their product mix away from low-margin items and towards high-margin items.
And that 1.6% expansion really cascades down the entire financial statement. I mean, when you are moving $62.7 million in a single quarter, those pennies aggregate into millions of dollars of available free cash flow.
Absolutely.
But look, I have to challenge the core of this 16% revenue growth for a second.
Fair enough. Play devil's advocate.
The headline looks fantastic, right?
Yeah.
But we know Acme United recently acquired a company called MyMedic.
Right, back in January.
So if a company is just buying top-line revenue through acquisitions rather than actually growing the demand for its existing products, that 16% is kind of a manufactured illusion.
It's just financial engineering at that point.
Exactly. I need to know how much of that growth is organic versus simply purchased.
Well, the CFO, Paul Driscoll, actually addressed this exact concern on the call.
Oh, he did? Good.
Yeah, the data shows that if you completely strip out the revenue generated by the MyMedic acquisition, the organic sales of Acme United's base business still grew at 8%.
Okay, 8% organic. That is actually really strong.
It is. They essentially generated half of their headline growth from the legacy operations they already own and the other half from the new asset.
Which indicates a highly robust core operation that isn't just relying on buying companies to show progress to shareholders.
Exactly.
But okay, 8% organic growth provides a really solid floor. But it brings us right back to the central puzzle of this earnings call.
The EPS lag.
Yes. If organic growth is strong and gross margins expanded beautifully to 42.6%, why are the actual bottom line earnings lagging so far behind?
It's a great question.
I mean, why did diluted EPS only climb 5%? The profit from those new sales seems to be vanishing into thin air before it reaches the shareholder.
Well, it's not vanishing. The missing profit is being entirely consumed by two distinct, highly strategic factors hidden within the operational mechanics of the business.
Okay, lay them out for me.
The first factor is the structural reality of how the MyMedic brand currently acquires its customers. And the second is the lingering accounting lag of global trade tariffs.
Okay, let's dissect the MyMedic situation first because it perfectly illustrates the friction of, transitioning a newly acquired asset.
Right. So Acme bought MyMedic in January of 2026, and MyMedic manufactures advanced first aid kits.
And we should clarify, we are not talking about standard adhesive bandages here.
No, not at all. These are comprehensive trauma kits. They are equipped with chest seals, tourniquets, airway clearing tools, serious gear.
Heavy duty stuff. So in Q2, MyMedic contributed approximately $4.3 million in revenue to Acme's top line.
Which perfectly accounts for that remaining 8% of the total revenue growth we talked about.
Right. But the transcript reveals a really crucial detail about that $4.3 million. It operated at breakeven.
Yep.
I mean, they did over $4 million in sales and added literally zero profit to the bottom line.
Zero net profit. And this is despite possessing incredibly high gross margins.
Wait, so the kits themselves are profitable?
Highly profitable. MyMedic is actually the primary reason the overall corporate gross margin was pulled up to 42.6%.
Wow. Okay. So the kits are cheap to make and sell for a lot. Where is the money going?
The capital destruction is happening entirely on the marketing side, because MyMedic currently operates as a direct-to-consumer or DTC brand.
They are bypassing traditional retail channels and selling directly to individuals on the internet.
Exactly. And running a DTC brand in the modern digital economy is financially brutal.
Oh, it's a nightmare. You are entirely dependent on social media algorithms for customer acquisition.
CEO Walter Johnson actually noted on the call that MyMedic has a following of 500,000 social media users and produces new video content twice a week.
But every single one of those impressions, every click, every converted sale requires massive digital advertising spend.
You are constantly feeding the machine at Meta or TikTok just to keep the sales flowing.
And that just aggressively inflates the selling, general, and administrative expenses, the SG&A line on the income statement.
It does. The financial footprint of that digital ad spend is glaring. Overall, SG&A for Acme United surged from $15.8 million in Q2 of last year to $19.9 million this quarter.
That is a $4 million jump in overhead.
Yep. As a percentage of total sales, SG&A jumped from 29% to 32%.
So that 300 basis point explosion in operating expenses just completely swallowed the 160 basis point improvement in gross margins.
Exactly. The new sales generated by MyMedic are highly profitable on a unit basis, but those profits are being literally incinerated by the sheer cost of digital customer acquisition.
Looking at the mechanics of this acquisition, it's like Acme United went out and purchased a high-performance sports car.
Oh, I like that analogy.
Right, like the gross margins are the horsepower. The engine is magnificent. It's capable of incredible output.
But right now, it is an absolute gas guzzler.
Exactly. The digital advertising costs are the fuel, and they are burning through premium fuel just to keep the car moving at its current speed.
Right. And if they keep running it this way, the acquisition makes zero long-term financial sense.
But I'm assuming that isn't the plan.
No, the telemetry on that sports car definitely shows it burning through cash right now, but management is not intending to keep driving it on the expensive toll roads of social media.
What's the pivot?
The stated integration strategy is to leverage Acme's massive pre-existing B2B and retail distribution network.
Oh, that makes so much sense.
They are actively working to transition MyMedic from a purely DTC model into mass market retailers and industrial safety channels.
Which changes everything. The unit economics change dramatically the moment you place a trauma kit on the shelf of a massive big box retailer.
Because you suddenly stop paying Mark Zuckerberg for every single eyeball.
Exactly. The inherent foot traffic of a massive retail store just naturally acts as your marketing engine. You trade the variable, unpredictable cost of digital customer acquisition for the fixed, albeit highly competitive cost of retail shelf space.
And the cost savings extend far beyond just marketing, too.
How so?
Well, integrating MyMedic into traditional retail channels allows for profound logistics consolidation. Think about it. In a DTC model, you are paying FedEx or UPS to ship individual, bulky first aid kits to residential addresses all across the country.
Right, which costs a fortune in freight.
The freight costs are astronomical. But when you integrate with a mass market retailer, you are suddenly putting full pallets of MyMedic kits onto the exact same trucks that are already scheduled to deliver Westcott scissors and Spill magic absorbents.
They just hitch a ride to the centralized retail distribution centers.
Exactly. You completely eliminate duplicate corporate functions and redundant freight lines.
You move the sports car off the public toll roads and onto your own private, highly optimized highway system.
That is a perfect way to put it. When that structural transition is complete, that $4.3 million in break-even revenue should violently swing into highly profitable operations.
But as Johnson admitted on the call, migrating a brand from the internet to physical retail planograms, it requires time. It doesn't happen overnight.
Which brings us to the second force actively suppressing their earnings this quarter.
The tariffs.
The tariffs. The delayed financial impact of global trade tariffs. To truly grasp why Acme's EPS only grew 5%, we have to examine the concept of capitalized inventory.
This is a big one, because this is where macroeconomic trade policy directly collides with quarterly accounting rules.
And it often confuses retail investors who expect instant financial reflections of geopolitical news.
Let's really dig deep into this, because the timeline here is wildly unintuitive. The transcript explicitly states that if you remove MyMedic from the equation, the gross margins for the legacy U.S. business actually declined by about 100 basis points.
Entirely due to tariffs.
Right. But the massive spikes in global tariffs occurred back in mid to late 2025. Why is a tax imposed in 2025 suddenly destroying profit margins in the second quarter of 2026?
The delay is entirely a function of standard inventory accounting.
Break it down for us.
So when a company like Acme United imports manufactured goods such as scissors from facilities in China and the federal government slaps a heavy tariff on those goods, Acme pays that tax in cash the exact moment the shipping container clears customs.
Right. The cash leaves the bank account immediately.
Yes. However, from an accounting perspective, that massive cash outlay does not immediately hit the income statement as a recognized expense.
It just bypasses the profit and loss statement entirely.
Correct. Instead, the cost of that tariff is added to the carrying value of the inventory sitting on the balance sheet.
The inventory is capitalized.
Exactly. The company has effectively purchased standard goods at an artificially inflated price and parked them in a warehouse.
Okay, so the crucial mechanism here is that the financial loss, the actual degradation of the profit margin, is only recognized at the exact moment that specific piece of inventory is finally sold to a customer.
Right.
So, to map this out for you guys listening, it is like I buy a lemon for $1 to make lemonade, but the government imposes a surprise $2 lemon tariff at the border.
Okay, I follow.
So I have physically paid $3 out of my pocket today, but on my financial books, I do not record a $2 loss today. I simply record that I have a highly valuable lemon sitting in my fridge worth $3.
Right, the asset value just went up on paper.
Exactly. I only realized how terrible this transaction was months later when I finally squeeze the lemon, make the lemonade, and I am forced to sell it to my customer for its normal market price of $2.
Because the customer won't pay $5 for lemonade just because you had to pay a tariff.
Right. The margin destruction hits me at the point of sale, not the point of purchase.
That analogy perfectly isolates the delayed pain of supply chain taxes. And CFO Paul Driscoll confirmed that Acme experienced its highest level of tariff spending beginning in June of 2025.
So they were forced to stockpile incredibly expensive, heavily taxed inventory throughout the back half of last year.
Yes, they stored it in their warehouses, and they are only just now pushing that specific batch of expensive inventory through their sales channels in the first half of 2026.
Which means they are currently squeezing the $3 lemons.
Exactly. And the data reflect that perfectly. The peak pain of flushing out that expensive inventory actually happened last quarter in Q1 of 2026, where management estimated it dragged gross margins down by 150. Yeah. But now, here in Q2, the drag has subsided slightly to only 100 basis points.
The sequential improvement from a 200 basis point drag to a 100 basis point drag, that is a massive mathematically bullish signal.
It really is. It indicates that the hangover is naturally fading. The most expensive inventory is finally bleeding out of the system.
More importantly, tariff rates actually experienced a reduction in November 2025 and another drop in February 2026.
Right, so the new inventory currently arriving at Acme's warehouses was imported at a significantly lower tax rate.
So as we progress into the back half of 2026, that 100 basis point margin drag will systematically evaporate, simply because the underlying cost of the goods being sold is returning to historical norms.
Exactly. And when you synthesize those two massive headwinds, absorbing the brutal digital marketing cost to integrate a new acquisition, while simultaneously eating the delayed accounting losses of a global trade war.
The fact that they still managed to grow earnings per share by 5% is actually staggering.
It is incredible. It means the core operational engine of this company is running incredibly hot, masked entirely by temporary accounting and integration noise.
And removing that noise reveals the true velocity of the base business, which we really can't discuss without looking at the resurgence of Westcott.
The cutting tools and legacy office supply.
Yeah. For decades, Westcott was the foundational identity of Acme United. And in this quarter, U.S. Westcott sales grew by 8%.
Which is a remarkable recovery when you consider the absolute bloodbath that division suffered in 2025.
Oh man, CEO Walter Johnson was incredibly candid about last year. He explained that their retail business was severely damaged by the uncertainty surrounding those exact same tariffs we just talked about.
Right.
The major retail partners essentially panicked and pulled the plug on their massive seasonal promotions. I actually want to explore the mechanics of why a retailer does that. If I am a big box store, why does a fluctuating tariff rate on the manufacturer's end cause me to cancel my back-to-school promotional displays?
Well, it comes down to the rigid mechanics of large-scale retail purchasing and margin forecasting.
How strict are they?
Incredibly strict. Major retailers like Target or Walmart operate on these incredibly tight logistical schedules. They design their floor plans, which they call planograms, and they negotiate their promotional end cap displays 6 to 9 months in advance of a major event like the back-to-school season.
Wow, 9 months out.
Yeah. And they demand absolute cost certainty to project their own profit margins. So if a manufacturer like Acme comes to them in 2025 and says, hey, we can supply the scissors, but because of volatile geopolitical tariffs, our cost to you might swing by 15% between now and August.
The retailer's risk modeling just breaks down.
Completely.
So the retailer simply refuses to take on that margin risk. They basically say, look, we will just stock the basic aisle shelves to meet baseline demand, but we are completely canceling the massive front-of-store promotional bulk buys. We are not allocating premium floor space to a product with an unpredictable cost basis.
Exactly. And that sudden withdrawal of bulk promotional volume completely crushed Westcott's revenue in 2025.
But the macroeconomic environment has stabilized in 2026.
It has. The retailer now has absolute visibility into their purchasing costs. Consequently, the promotional engine has been turned back on.
Johnson explicitly stated on the call that Westcott has a full book of promotional activity locked in for the upcoming back-to-school season.
He noted that the brand has legs again.
And crucially, when an analyst pressed him on whether that 8% growth was merely the result of Acme raising unit prices to combat inflation, Johnson clarified that the growth was predominantly driven by physical volume.
Which is the healthiest kind of growth.
They are actually moving more physical units of scissors because the massive retail buying cycles have normalized.
And they possess an incredible competitive moat in that specific niche. Johnson highlighted their proprietary titanium coatings and non-stick utility patents.
They're the dominant global player in specialized cutting tools, which affords them immense pricing power.
It does. And the stability of that legacy business is essentially serving as the cash-generating fortress that allows them to fund their aggressive, high-margin healthcare pivot without taking on destructive levels of debt.
It perfectly illustrates the symbiotic relationship between a mature legacy brand and an aggressive growth acquisition.
Right. So now that we have established the underlying health of the current quarter, we need to pivot toward the future.
Yes, let's talk guidance. Because the management guidance provided on this call was extraordinarily dense with forward-looking strategic maneuvers.
Particularly regarding how they are positioning the board for the fourth quarter.
The guidance surrounding the MyMedic brand was honestly the most eye-opening part of the transcript for me.
Really? Why is that?
Well, we discussed the brutal costs of running it as a DTC brand. But management revealed a fascinating structural tailwind regarding the timing of those sales.
Oh, the seasonality.
Yes. Roughly 35% of MyMedic's total annual revenue is generated in the fourth quarter alone.
Which is wild.
That level of seasonality for advanced trauma kits seems entirely counterintuitive. You do not naturally associate chest seals and tourniquets with seasonal holiday shopping.
It only appears counterintuitive until you analyze the underlying consumer psychology and the structural incentives of the U.S. healthcare system.
Okay, unpack that. Because an analyst on the call actually probed this, right? Asking if the fourth quarter spike was driven by institutional buying, like local fire departments or municipal agencies, placing bulk, end-of-year direct orders.
Right. But management clarified that the volume is still overwhelmingly driven by individual consumers reacting to two massive Q4 catalysts. The first is high-end holiday gifting.
Like the Black Friday and Cyber Monday surge.
Exactly. They are positioning these comprehensive, rugged first aid kits as premium gifts for the outdoor enthusiast, the hunter, the camper, the overlander.
Which makes sense.
Yeah.
But the second catalyst is vastly more reliable and structurally ingrained into the economy.
Flexible spending accounts.
The expiration of FSAs.
Yep. Millions of U.S. employees contribute pre-tax dollars into FSAs to cover out-of-pocket medical expenses.
And the defining characteristic of an FSA is its use it or lose it mandate.
Exactly. As December approaches, consumers realize they have hundreds, sometimes thousands, of tax-advantaged dollars that will literally vanish on January 1st if unspent.
It creates a massive artificial demand shock. I mean, consumers frantically search for eligible medical supplies to burn off that expiring cash.
And dropping $200 on a high-end, comprehensive MyMedic trauma kit for the trunk of your car is the perfect mechanism to capture that expiring FSA capital.
That is a brilliant structural tailwind that Acme is inheriting.
Now, combine that built-in 35% Q4 revenue spike with the strategic retail integration we discussed earlier.
Right, moving them out of DTC.
Exactly. Management is actively pitching MyMedic to major mass market and industrial retailers right now. If they successfully secure those retail placements ahead of this Q4 seasonal rush, the operating leverage will be explosive.
Because they will capture that massive surge in consumer demand without having to proportionally scale up their digital ad spend.
Because the retail partners will be carrying the distribution load and capturing the foot traffic?
The CEO practically telegraphed this to the market. Johnson explicitly stated they are building towards the operating leverage that we hope should start to become apparent in the fourth quarter.
He is essentially pointing a massive neon sign at the Q4 margins and telling investors to watch what happens when the DTC expenses fall away right as the seasonal revenue spikes.
It is the architectural blueprint for a massive earnings feed, assuming the execution matches the strategy, of course.
Right. But executing a global supply chain strategy in 2026 is inherently fraught with risk. Which brings us to one of the most fascinating defensive maneuvers revealed in the transcript.
The inventory buffer.
Yes. Management casually noted that when the recent war involving Iran escalated, Acme United deliberately went into the market and ordered an extra $10 million in inventory.
Just to build a buffer against potential supply chain disruptions. I want to spend some time on this. Because holding an extra $10 million in physical scissors, bandages, and absorbent materials that ties up a massive amount of working capital.
It does.
Standard MBA theory dictates that you run a lean, just-in-time inventory system to maximize cash efficiency. Hoarding $10 million worth of product seems like a terribly inefficient use of capital. You called it a defensive maneuver, but I need you to explain the mechanics of why tying up that cash is actually a masterstroke of macro management.
To understand the brilliance of that $10 million buffer, you have to look at the specific macroeconomic variables management was hedging against.
Okay.
The first variable is the localized cost of global shipping, specifically the price of bunker fuel.
Bunker fuel being the extremely heavy, viscous fuel oil that powers the massive cargo ships traversing the oceans from Chinese manufacturing hubs to U.S. ports.
Precisely. When a geopolitical conflict erupts in the Middle East, specifically anywhere near the Strait of Hormuz or major global energy arteries, the risk premium on crude oil spikes violently.
And the cost of bunker fuel skyrockets in tandem.
Right. Furthermore, if shipping lanes are deemed hostile, insurance rates for ocean freight explode, and commercial vessels are forced to take longer, slower routes.
Like going all the way around Africa instead of through the canal.
Exactly. By preemptively deploying $10 million of their capital to purchase and ship inventory immediately at the onset of the conflict, Acme effectively locked in their ocean freight rates before the geopolitical risk premium could inflate them.
Wow, so they recognized the threat, and they essentially prepaid for thousands of miles of shipping at the old, cheaper baseline rates, insulating their future gross margins from the chaos of the spot market.
It's incredibly smart. And the shipping hedge is only half the equation.
What's the other half?
The second variable they were defending against is foreign exchange volatility.
The dollar.
Yes. Over the past year, the U.S. dollar has experienced periods of weakness against the Chinese yuan. When the dollar weakens, it takes more U.S. currency to purchase the exact same volume of goods from a Chinese factory.
That currency fluctuation acts as a silent, direct hit to a manufacturer's cost of goods sold.
Exactly. So by aggressively hoarding that $10 million inventory buffer, they are executing a massive currency hedge.
They locked in the purchase price of their goods at a specific, favorable exchange rate.
Yes. Temporarily shielding their profit margins from any further degradation of the U.S. dollar.
It is the ultimate insurance policy. They literally weaponize their own balance sheet to purchase absolute price certainty.
Which prevents them from being forced into a corner where they have to suddenly raise prices on their retail partners to cover spiking freight or currency costs.
And as we established during the 2025 Westcott debacle, sudden price hikes cause retailers to panic and cancel promotions.
Exactly. This $10 million buffer guarantees that Acme will have product on the shelf at a mathematically known and stable cost basis, regardless of what happens in the global energy or currency markets over the next 2 quarters.
It is phenomenal foresight. They are playing three-dimensional chess with their supply chain logistics.
They really are.
And while they are executing this impenetrable defense on the macro side, they are playing wildly aggressive offense on the operational side.
Oh yeah, the other healthcare segments.
Right. The guidance provided incredible updates on the scaling of SpillMagic and MedNap.
The expansion happening within SpillMagic is a perfect case study in margin expansion through automation.
SpillMagic produces the high-performance absorbent powders used for rapid cleanups of hazardous spills, oils, bodily fluids, basically anything messy in grocery store aisles and massive industrial settings.
And the transcript notes, their sales are up a blistering 30% year to date.
30%. To handle that volume, they just completed a transition into a brand new 78,000 square foot manufacturing facility situated on 12 acres in Tennessee.
But the critical detail Johnson revealed about this facility is the ownership structure.
They got it outright, right?
Yes. Because Acme chose to purchase the facility outright rather than leasing it, they are heavily incentivized to invest in permanent, long-term infrastructure.
Which they are doing.
Big time. They are currently installing state-of-the-art robotic automation into the bagging and palletizing lines that is unparalleled by their competitors.
Let's model out the economics of that automation. When you are growing at 30% organically, your primary operational bottleneck is labor.
Always.
If you rely on human labor to bag and load pallets, your costs scale linearly with your growth. Every new order requires more hourly wages, more overtime, more variable costs.
Right.
But by deploying robotic logistics systems, they are fundamentally altering the cost curve. They are replacing those scaling variable human labor costs with a fixed, depreciating automated asset.
As that 30% top-line growth continues to compound, the robotic lines process the extra volume at virtually zero marginal cost.
Which will drive the operating margins of the SpillMagic division through the roof.
It is a textbook application of operational leverage. And while SpillMagic is automating, their other subsidiary, MedNap, is preparing to assault a massive new total addressable market.
MedNap is based in Florida, right? They manufacture antiseptic wipes and alcohol prep pads.
Correct. Currently, they sell primarily into commercial channels and industrial first aid kit manufacturers. But Johnson outlined a strict timeline for completing major regulatory upgrades to the MedNap facility by the end of 2026.
The ultimate goal of those upgrades is to achieve the rigorous FDA certifications required to supply the U.S. hospital market.
And the barriers to entry for hospital supply chains are notoriously brutal. You cannot just walk in and sell them alcohol pads.
No, you need flawless regulatory compliance, audited manufacturing processes, and absolute supply chain certainty.
The moat surrounding the hospital supply sector is immense, which is exactly why the margins are so lucrative.
If MedNap can successfully clear those regulatory hurdles and integrate into major hospital purchasing networks, the revenue ceiling for that division is no longer constrained by the commercial first aid market.
It completely changes the valuation multiple you can assign to that asset.
Johnson was realistic about the difficulty of the process, but confidently stated that the work is progressing steadily toward a year-end completion.
It represents another massive asymmetrical catalyst waiting in the wings for 2027.
And this growth isn't isolated to the U.S. either. The global segments are firing as well.
Right. European sales were up 19% in local currency.
Canadian sales grew 3%, driven entirely by robust demand for industrial first aid solutions. Every single division of this machine seems to be pointing in the exact same direction.
They are executing on all fronts.
Which brings us to the ultimate objective of this deep dive. We have meticulously unpacked the headline numbers. We have analyzed the hidden stories of digital acquisition costs and delayed tariff accounting.
We have mapped out the strategic guidance and the macro defenses.
It is time to deliver the verdict.
Okay, let's do it.
The foundational takeaway for any investor analyzing this quarter is the undeniable mathematical shift in the company's core identity.
Products in the healthcare and safety category now comprise a staggering 70% of Acme United's total global revenue.
70%. If you are a retail investor still conceptualizing this stock as a legacy scissor and ruler company, your mental model is objectively incorrect.
Totally outdated.
They are a high-margin healthcare logistics company that merely happens to own a highly profitable, cash-flowing legacy office supply brand.
And crucially, this massive corporate pivot is being entirely funded by the internal cash generation of their own operations.
That's the best part. Over the trailing 12 months, the combined enterprise generated $15.5 million in pure free cash flow.
They deployed that cash with surgical precision.
They really did. They paid $14.5 million upfront to secure the MyMedic asset. They acquired a specialized German manufacturing line for $1.6 million, and they still returned $2.4 million directly to shareholders in the form of dividends.
Now, I am looking at the balance sheet, and their net debt did tick up slightly, moving from $22.8 million to $27.3 million.
But the context is vital here. They just closed a massive new $65 million syndicated credit facility, locking in their access to capital until July of 2029.
So liquidity is absolutely a non-issue. They have the financial firepower to weather any macro storm or execute further acquisitions.
So, with all the data on the table, I need your definitive, opinionated stance. Based on the mechanics of this earnings call, is this a bullish or bearish signal for the retail investor?
Based on the deep structural analysis of their headwinds versus their tailwinds, this Q2 earnings report is a strongly, undeniably bullish signal.
Outline the asymmetry for the listener. Why is the risk to the upside?
Because every single factor currently suppressing their valuation is mathematically temporary, while every factor driving their growth is structural and accelerating.
Okay, summarize the temporary stuff.
The delayed accounting lag of the 2025 tariffs is physically bleeding out of their warehouse inventory. The margin drag is fading. The massive upfront digital advertising costs required to sustain MyMedic as a DTC brand are about to be slashed as they successfully migrate the product onto traditional retail planograms. The headwinds are entirely transient.
While the tailwinds are logged in, you have a normalized, predictable retail environment that has fully reactivated Westcott's high-margin, massive volume promotional buys.
Yep.
You have a Spill Magic division compounding at 30%, while simultaneously deploying robotics to crush their variable labor costs. You have the massive Q4 seasonal surge for MyMedic about to collide with expiring FSA accounts, supercharged by new retail placements.
And perhaps most importantly, you have a management team competent enough to proactively lock down a $10 million physical inventory hedge, completely shielding these impending profit margins from the chaos of global shipping and currency markets.
The strategy is not just theoretical. It is actively working and showing up in that 160 basis point gross margin expansion we started with.
Which gives us our clear, actionable takeaway for the listener.
Give it to them.
If you are currently holding this stock or considering initiating a position, and you want exposure to a microcap that is successfully shedding a stagnant office supply multiple for premium healthcare and safety valuation, this quarter is absolute proof that the thesis is intact.
The play here is to hold or strategically accumulate in anticipation of the Q4 revenue pop and the subsequent explosion in gross margins as the legacy tariff drag finally vanishes from the balance sheet.
It is a classic setup for a patient investor willing to look past the noisy EPS lag of a single quarter.
Hold for the Q4 pop. The data supports it, the macro environment aligns with it, and it cuts straight through the noise.
Definitely.
But before we close out this extensive deep dive, I want to leave you, the listener, with one final, highly provocative thought.
Oh, I know where this is going.
We have spent this entire time analyzing Acme United as a manufacturer of physical goods. But tucked quietly into the middle of the transcript, CEO Walter Johnson casually dropped a detail that could fundamentally shatter the entire trajectory and valuation model of this company.
The smart compliance rollout.
The smart compliance software. Johnson noted they are in the final stages of deploying their next-generation smart compliance system.
For context, this is their proprietary ecosystem for managing massive industrial first aid stations in factories and commercial buildings.
It was originally designed simply to keep the kits organized and compliant with OSHA regulations.
But the next generation is an entirely different beast.
Management revealed they are integrating internet-connected scanning technology directly into the physical first aid cabinets on the factory wall.
This system actively monitors the inventory levels of the bandages, the burn creams, the eye wash stations.
And when supplies run low, the software automatically generates and submits a replenishment order via the internet, completely bypassing human intervention.
It eliminates the massive friction of relying on a safety manager to manually audit the box, fill out a requisition form, and process a purchase order.
Exactly. And I want you to truly ponder the financial implications of this mechanism. Right now, the market prices Acme United as a consumer goods company. They manufacture a physical item, they sell it once, and they have to fight to win your business the next time you need one.
But if this internet-connected smart compliance system achieves widespread adoption,
if they successfully trap these massive industrial clients inside a sticky, automated, frictionless software ecosystem where the factory is essentially subscribed to recurring, automatic refills,
the underlying financial architecture of the division ceases to be manufacturing and becomes a recurring revenue model.
Precisely. If they transition from selling one-off hardware to managing an automated algorithmic supply chain network, do they stop being valued as a traditional consumer goods company?
Do they start commanding the astronomical valuation multiples typically reserved for B2B software as a service platforms?
SaaS companies trade at vastly higher premiums than scissor manufacturers because recurring software revenue is infinitely more valuable than a one-time physical sale.
If smart compliance becomes the default operating system for industrial safety, Wall Street is going to be forced to entirely reevaluate how they price this stock.
It highlights the absolute necessity of reading the primary source material. You start digging into a standard earnings call, looking for the volume metrics on elementary school scissors, and if you look close enough at the mechanics, you might realize you are actually staring at an emerging automated healthcare software platform.
And that relentless pursuit of the underlying mechanics is exactly why we do what we do on this deep dive.
We are here to bring you the unvarnished data, translate the complex strategies, and deliver fast, actionable retail investing insights straight from the corporate transcripts.
Thanks for listening.
Thank you for joining us as we unpack the hidden metamorphosis of Acme United. Until next time, remember that the true value of a company is rarely found on the label of its box. Keep questioning the consensus, keep drilling into the gross margins, and keep hunting for the catalysts hiding in plain sight.